Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Greene shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. My guest today is Chris Grenzig, and we're talking trust building through transparent property management solutions, so you know where we're going. But what I want you to know about this episode and what I liked about it so much is that Chris is brutally honest about himself, the way that he's done his business, what he's learned from success, and what he's learned from failures. All markets are not the same, and Chris goes through all of his journey to help you on your journey right now. This is episode 295 of Zen and the Art of Real Estate Investing with my guest, Chris Grenzig. Chris is the founder of JAG Property Management and JAG Capital Partners, a vertically integrated multifamily-focused investment firm. They look to acquire multifamily in Jacksonville and Orlando, and they also do a lot of managing for owners as well. Chris, welcome to the show.
Yeah, thanks for having me on.
Yep, we were just talking about it. I was on a podcast with you and your co-host at the time, John, like way back in the pandemic. So it's good to see you back here, and you've accomplished a lot since then. What's the difference in terms of your trajectory over the last 4 years since we spoke?
Yeah, I can't remember when exactly. I'd have to check the date, but in 2020, we started the podcast while I was working for Toro, which was John's company. I just worked there. And then in November of 2020, I left to start my own company, depending upon what the timing was. Could have been a much bigger shift. But yeah, moved from New York to Jacksonville, Florida, while we were buying a 16-unit property down there. Decided I was going to do the property management and renovation / construction management myself, which, I'd never done before at Toro. We always outsourced that, left it to the property managers, or for a few of our larger construction deals, we had an owner's rep on. So decided I was going to do that. Moved down Thanksgiving weekend, 2020. We bought that property. Since then, we've bought 150 units. We still own 51 in Jacksonville. We have self-managed everything. And then in late 2023, my now wife and I, who I met in Jacksonville after moving, we relocated to the Orlando area to be closer to family, some friends, things like that. And we also decided to get licensed to start doing third-party management as well. So with the move, we were already looking to acquire properties in Orlando. We decided to do, property management for other owners in both areas. We would definitely acquire something in Orlando. We haven't as of yet. It's been a tough couple years in Florida on the acquisition side.
Yeah, it's interesting.
But yeah, we had our portfolio in Jacksonville that we owned and we were managing. I had a lot of contacts and network up in Jacksonville, and some people that work for me in Jacksonville that were still local, because it would be difficult to continue to do the day-to-day myself 2 hours away. So just decided to build up both areas in the interim, and who knows, maybe that'll change in the future.
Yeah, awesome. Well, what made you know you could take on a 16 unit and do the renovation and management? I mean, obviously you had some experience, but that's a pretty big chunk to take off on your own and go to a new area.
Short answer is I didn't.
But then why did you? Because I think that's what a lot of newer investors struggle for is, should I take action? Am I in analysis paralysis? How do I get the confidence to say yes?
So a big part of it was I think the asset management experience gave me confidence that worst case scenario, if I'm doing a poor job of property management and construction management, I can find somebody who can help me with that process. What also helped me was my father was a partner of mine, and he has a lot of experience with construction. He's electrical engineer by trade. So he knew a lot of things that I didn't. And some of it we learned ourselves because he had never worked on apartment buildings, but he quasi built an extension on our house by himself, just brought in a contractor as necessary, is just very intuitive by nature. So there were some things where, and I had some people I knew that were in property management that were helping me. I reached out to a lot of people. So on my drive down from New York, actually, I think it was about 17 hours.
Yeah, I've done that many times.
Yeah, I had 10 calls scheduled primarily with property management people on that drive down because I was very nervous and very anxious about going down. And I just said, well, I need to find people I can reach out to and ask questions as things pop up. And a lot of those people I still am in touch with and, still help me and have helped me get started and get my feet underneath me. But yeah, it was a lot. I mean, when we bought the property, there was a tenant that was actually in a pending eviction. And within like 2 days of being down there, the sheriff called me and was like, hey, we're ready to do the set out. And I was like, I don't know what you're talking about. I was like, I've overseen evictions, but I've never had to do it myself. Yeah. So fortunately, the management company that I had for the previous owner was very nice, very understanding, and kind of, helped me through that process a little bit. The landlord eviction attorney I knew helped me as well. And we were able to just kind of figure it out. I did actually make a mistake that didn't shoot me in the foot at that time, where after we did the eviction, I let the resident back in without any oversight to just go grab their stuff. And luckily, they didn't do anything. I didn't give them a key. I just opened it and let them back in. But we wouldn't do that now anymore. So luckily that didn't hurt me. But yeah, I just kind of said, I'll figure it out. And just little by little, we figured it out. And there was plenty of mistakes that I learned from throughout. I mean, I'm still learning them today. So.
Yeah. I mean, what did you like the most about the asset and the area that made it okay to kind of wing it and figure it out? Definitely having your dad help. Anybody with engineer in their title, great at everything inside of a house. If you give them a spreadsheet, they're going to disappear for 6 hours, but that I'm sure that helped. But what was it about asset versus price versus location, scale that really just made it like, yeah, I got to do it?
So for Toro, we had bought a property in that same submarket, same vintage with the same floor plans, like 6 months prior.
Oh, that's perfect. Yeah.
When the way it kind of evolved was when 2020 kind of rolled around, the way my compensation package worked with Toro was I had kind of come into a good chunk of money just sitting in my account. And I was trying to figure out what to do with it. And I was like, well, maybe instead of just investing in all the deals, maybe now's a good time to go out and buy something for myself and just not be so reliant on one group. Nothing against John or Toro or anything. It's just like diversify anything, right? Yeah. So started having conversations, and literally shortly thereafter, I think that was like February, is when COVID kicked off. And a lot of people at that time thought this was going to be an unbelievable buying opportunity where things were going to crash and there's going to be a lot of problems. So started having conversations of like, hey, we need to be ready to pounce on some things in case something pops up. Obviously, that didn't quite happen. However, just by the nature of talking to people, this property came up where it was a much larger owner that owned a bunch of smaller properties in town. This one was kind of offset from the rest. All the other ones were a lot closer together.
Perfect.
They had really been struggling. They were trying to self-manage, then not self-manage. They brought another management company. Their expenses were all over the place. They were starting to get occupancy back up. There was a lot of original finishes. So it was just something where it was right out of the playbook of something I knew we could step into and at least figure it out one way or another. And my original intention was not to manage it myself, but it was just kind of one of those deals where you looked at and kind of hear them out. And you're like, oh, that is a nice looking deal and made sense. And just a lot of reasons why I felt I was the right buyer for it, which was a big question we always ask ourselves of like, why should we be the ones to buy this?
Yeah, I mean, what a great thing to have that playbook from Toro that locationally, you really knew a lot of the numbers right there. So when you're plugging them in, at least you knew like, I can't mess this up. I could mess it up, but I can't.
Yeah.
I'm not going to lose money. Like the asset's too good. You just have to do the upgrades. One more thing, though, I love what you said about the owner, because I've always said, I'm always looking for multiple owners when I'm doing tax searches and stuff. And people always ask them the wrong questions. You always want to ask, like, do you have an outlier property? Is one farther away than the others? Or is one you just hate? There's properties that they just can't get a hold of. And this is a perfect example where they're ready to just cut it loose. That the price doesn't really matter. They just don't want to deal with it as long as it's reasonable and someone can take over. Both of those things obviously really played into this asset, making it perfect to go big on a 16 unit.
I think another thing that really played an important role at that time was because of all the things happening with COVID and us having, I think Toro at that time had about, because we had sold a property or two, I think we had about 800 units at the time in the market.
Yeah.
We were having weekly calls with management, and I had been down there a couple times during that year. I would say maybe May to September, I think is when I got the property, or August.
Yeah.
So we were very in tune with what was going on, and I think probably more in tune than a lot of other people. I think there was a lot of hangover of how much COVID was affecting. And I think at that time, we kind of felt at that point that things weren't nearly as bad as we thought they were going to be. Collections were still very strong. Occupancy was still very strong. There was a lot of things in place that this wasn't all doom and gloom. And we were just able to come in and find a guy who, these were basically side projects for him. And I think this one in particular was probably the best of the bunch, and he might not have realized, because he wasn't super hands-on. And I think he just saw an opportunity to get rid of one.
Yeah.
And he had bought it at a pretty good price, so he still made money on it. It wasn't like, he might have lost money through cash flow and things, but it's not like he sold it for a loss on paper for basis.
Yeah, it's a win-win,
Yeah, and it was just, we countered 10% below what he asked, and I think he just kind of went, whatever, just sell it. And I sit here, I'm like, I should have asked for more off, but you live and learn.
I always think that if you can get that win-win and it's just easy, what's another 10 grand in this
Exactly.
of the project? You turned it around. It went great. Like, he did well. And like you said, maybe it was a better asset, but it just wasn't one of the ones that was in his wheelhouse for him to be his favorite. So he probably got it, thought it was going to be easier. And then it's just kind of like, rotating and not doing anything. So it's much better for him to get out with some plus and then turn it over to someone who can, focus on it.
Yeah, absolutely. And we got lucky too, because the timing was right before, Florida, late 2020, early 2021, rents started going crazy.
Yeah.
So we closed at a perfect time where our pro forma rents, I think, were $1,050 renovated. And at the height, now it's come down.
Yeah.
But at the height, we were renting them for $1,350.
Yeah, nice.
So I think now they rent for... It's a weird market right now in Florida, which I'm happy to get into. But I think they rent anywhere from $1,200 to $1,300, just depending upon all the things that are going on.
Yeah, having spent 14 years in Florida and invested there a lot, I feel like it's always potentially a weird market, because when the market shifts, Florida is always in the shift part of it. So you kind of just have to figure out which way you're going, right? Is that what you figured now with all of the turns from COVID to now? Especially now there's more inventory, but the deals actually don't look that great in multi, and you have to adjust your rents to suit what's out there.
Yeah, it's been a really tough market to navigate the past 3 years. We've had rents drop over 20% on some properties and floor plans. I would say probably the average is 15%, give or take. It's, anywhere from 150 to, $150 to $200. So yeah, that's really tough to navigate, and not something you really go into a deal expecting. And a lot of times you look at your break-even occupancy, or you look at how low can rents drop. But the problem is that was combined with a lot of other things.
Yeah.
Like everybody else, interest rates went from 4% to 6-7%, depending upon time period and loan type and things like that. Insurance rates doubled or tripled depending upon the property and exactly where you were. They 5x'd from when we first started in Jacksonville back in 2017. So, nobody underwrites for that. Vacancy expanded. Obviously, rents dropped, which I touched on. Construction costs went up a lot. So, what used to cost $2,000, $2,500 for an AC replacement is now $4,000 to $5,000. It just really depends. So it was a little bit of a perfect storm to the downside. And fortunately, we've done okay. But, one of our properties has really struggled, which we bought in early 2022. Another one is doing okay. And then that deal I was talking about is doing fine. But, we refied, we pulled out some money. We have like a 4% something rate, 4.5, something like that. I think it's like 4.5, but it's not doing as well as it was. It's still $200 less times 16 units a month. If somebody wants to do the math, I would hate to do that.
It's a big shot in value. Yeah.
Yeah. It's shot in value, shot in cash flow. It's tougher to keep reserves for things that, that break. And, it's still a 1960s property, despite us replacing all the water lines, replacing a bunch of sewer lines, replacing a bunch of ACs. We renovated all the units, spending about $15,000 a unit. We redid the we did a ton of work. We spent about $35,000 a unit on average for that property, and stuff still breaks. And we still got to replace ACs, and it's not fun. So.
Florida weather doesn't help on the exterior and mechanicals of buildings too. It's just so hot, so humid, and it's just a different beast. But I think this is a good lesson for people. You have to figure out how to tread water. Were any of these properties intended to sell, and then it was like, well, now we can't sell, our value's down because of these low rents, and now you're just kind of figuring out, hey, let's get through the cycle, see what we got, and then we'll check our valuation when things go back up?
Yeah. So our business plan for all of our properties that I really wanted to do was find medium to heavier value add properties, renovate soup to nuts in the first 2 or 3 years, refi and hold. Yeah, I always felt the game of coming into multifamily, and a lot of this was when I was with Toro, looking at 100 to 500 unit properties, coming in, redoing the exterior, redoing the common area, renovating 10% of the units, and trying to sell for, a low cap rate was I don't want to say a losing game, but a game with a short leash.
Yeah.
Where if you don't actually increase the NOI a ton, if your worst case scenario happens, it leaves you really in a bad position to refinance. And with a lot of times a very short loan period, if you're doing a bridge loan, that's only 3 years. So we found a lender that we didn't do bridge loans on all of them, but we found a lender that would do a bridge loan for 5 years at a fixed rate, which has helped us tremendously, but it's still been painful. And we refinanced 2 of the properties we bought. We ended up selling one of the properties we bought because it was going to need all new roofs, and we would have had to spend all the refi, the money we pulled out into new roofs. And we're just like, we'll sell it, and we made good money there. And then 2 of them, we're now in the position where, the refi is difficult. We're looking at a million different possibilities. But it's difficult because the rent's dropped and we're not hitting, the valuations we thought we would get, and cap rates and interest rates. So things have really worked against us there. And, we're having multiple conversations with, all parties involved, investors, the GPs, lenders, things like that, and trying to figure out what the best route is forward for each of them. I probably can't go into too much more detail than that, but it's a process we're all working through, and everybody's been really great about it because it's clear that, the market has had a large impact on all these things. Yeah. Everybody involved really didn't see it coming, or else they wouldn't have been involved in the project. I certainly didn't see it coming. And, I invest my own personal money above and, any fees that I get into those deals. So, I've put a lot of my own personal and my family's money into these deals, and it hasn't been easy to deal with. And we're just making the best of what we can.
Yeah, I feel like investors who are in, if they're LPs or, family friends, can see the difference between a good operation that did well and then a market that tanked, instead of an operation that tanked and the market's the same. There's a big difference in terms of investor sentiment on the project. Like, hey, okay, you did everything right, the market, but that's Florida investing though. It really turns harder than most states in the United States when things turn.
Yeah. And it was tough in Jacksonville as well, because shortly after our more recent acquisitions, Jacksonville was ranked for about 2 or 3 years in the top 10 in the nation for new amount of housing units being built as a percentage of existing units. So percentage wise, it was growing one of the fastest in the country. And even though Jacksonville has strong employment growth, population growth, it just outpaced, and supply and demand shifted. And that's why rents dropped.
Yeah, because there's newer stuff. You're a 70s build, and there's newer stuff that's going to undercut you.
Exactly. And fortunately, but also unfortunately, we did hit our first year projections pretty much, as close as you can get, right? You're never exactly perfect, but we achieved our rents, our expenses were in line, we were hitting our NOI, a couple fluctuations. Sometimes occupancy was a little lower. These heavy value add deals, you run into stuff all the time that you really couldn't know going into it, and you've got to just pivot and figure out. And that's why we always have a contingency in our renovation budget, usually of at least 10%, to account for those things. Sometimes it adds delays. So we definitely had some small issues that maybe we could have done a little bit better or managed differently, or who knows. I'm not infallible by any means.
Yeah.
But it's been a little bit easier to have some of these conversations where it's like, the first year we were doing everything we said we were going to do. We were doing distributions. One of the deals had phenomenal distribution. And then it just started changing, and it felt like it changed really slowly. And then it just kept going down very quickly for a long time. And, on the acquisition side, we haven't bought anything since 2022 because it's been extremely difficult to make deals make sense on paper. For a while there, it was impossible to forecast because insurance was going up every month. And anytime we would talk to our agent or broker, I think he just got so sick of me calling, because I'm not the only one calling him about these things. And he has no answers, but it's like, hey, what should we budget? And then I'll be like, well, what should we also budget for next year? He's like, put in $2,000 a unit and then put in whatever you want for next year, because I have no idea. And it's like, what do you do in that situation? You can't buy something. You can't go to somebody and say, hey, there's a good chance it's $2,000 a unit by the time we close, but it might be $2,200.
Yeah.
And then next year, I don't actually know, but we're going to put in 3% expense growth and cross our fingers and hope it works. Like, that doesn't work. And if you put in, anything above that, you were never buying a deal because it didn't make sense on paper. So it was just, it was and continues to be a very difficult time on the acquisition front.
Yeah, insurance got a big knock after that building fell in Miami all over Florida, like really pushed the stuff up. And then it's Florida, so you're always dealing with climate type of risk and, rains, floods, tornadoes, that type of thing. I remember when I lived there, it would be like, oh, a hurricane's coming. It's probably better on the forecast now. So I drive, from one coast to the other, and then they'd be like, oh, it's moving back. And by the time it came, I would just drive back and I would never hit rain because it's just Florida, So it's just another layer of stuff to deal with over the top.
Yeah, it's been eye-opening, and it's been an interesting experience to go through, and it has not been easy for myself, my wife and I, just on a personal level. For my other family involved, and my friends and investors who are involved. It's been a difficult couple of years to manage and work through. So I think we'll be better off for it over the long term. But yeah, it's been an interesting experience that is tough to really talk about and understand if you don't actually go through it.
Yeah, it makes sense. Let's throw it all the way back, though. Before the 16 unit, when was the first time that you were really interested in doing real estate and making it part of your life?
Yeah, I got started in 2016. So I graduated college in 2014. I played Division I soccer. I had no idea what I wanted to do after college. I fell into a Division II coaching job up in Massachusetts and said, I'll try that. Tried that, missed home, moved back, got another coaching job. But I thought Division II coaching is, you get paid, $5,000 a year, and it's part-time. So you have to do youth coaching or something else to live, or camps, different things like that. So I figured, well, instead of doing other coaching stuff, let me try getting a different job, seeing what's going on. Got a job working in like a finance company. And then my mom and cousin bought a flipping course and wanted to just start doing flipping. So they said, do you want to come along? I said, sure. And we started trying to do that. It was incredibly difficult to find flipping opportunities in Long Island. I do think it's possible, and I know people that do it, but it's not. I think a lot of things changed anyway from what people were doing in 2012 to 2015. And I think that in order to be a successful flipper from 2015 to 2020, you had to do it differently than a lot of coaches and courses were saying. And I think we were kind of caught up in that. So we started looking at out-of-state flipping. And then we met John Cohen, who was doing a lot of smaller multifamily stuff. And I just started Toro with Don to start doing larger multifamily stuff. We connected with him. We started looking at doing some stuff together. We partnered on a couple smaller deals up in Kentucky. And then I knew I wanted to be out of coaching and do something else. I just happened to be talking to John, and I was like, are you guys hiring or anything? And he was like, well, why don't you come work for us on like a trial basis for 3 months or something?
Yeah.
I think I was getting like $500 a month. No, $500 a week, which is not nearly enough to live on in New York. But I was like, whatever, I'll figure it out.
Yeah.
And 3 months turned into 4.5 years.
Yeah. Something you said really struck me, because I feel like now there's a lot of newer investors who are reading, the Bigger Pockets books on how to flip and how to BRRRR, but it doesn't work in this market. So like, what can happen in 5 years? The actual functionality of how you do a BRRRR is the same. It's just that you can't do it because the rates don't, apply. You have to think of it differently. Do you feel that people are missing out on that now? Like they're still trying to capitalize on stuff that worked 5 years ago. I mean, flipping's not even the same. The cost of construction is so much higher.
I can't speak too much to flipping because I haven't really ever done it. The only thing I can say is from late 2022 until we decided to start doing the property management stuff in basically January of 2024. It's about a year and a half-ish. We were trying to figure out what to do next. And I looked at a lot of different things. And my wife had actually worked as like a project manager for Flipper in Florida. And so we looked at flipping, and I couldn't make it make sense. The cost that people, like the percentage of people's total cost, including like a moderate time of holding costs, closing costs on both ends, carrying costs, all that. I mean, the percentage people would go up to was astronomical. It was like in the 80s and 90%. And I'm looking
for very
at like,
slim out
and it's
margin.
Like, you might, you're looking at like, even if you're at 90%, you're going to sell something for, $250,000. Yeah, that's $25,000. But if you're off anywhere, that disappears so quickly. And I looked at it, and I don't know what that percentage would have been through that flipping course back in the day. I can't imagine it was much different, but I look at that and I'm like, that makes me extremely uncomfortable, especially as we were going through all of these things with the rental market and our multifamily stuff. I was like, if the retail market starts coming down, if supply keeps going up, and, it's taken a while for the retail market in Florida from what I've seen, which isn't a whole lot. I'm not an agent. I don't actively buy and sell, but prices have really started coming down in the past year. If you built up a whole business, you have overhead, you're doing multiple flips a year or multiple flips a month, you get, pinched very, very quickly. And it just never felt like enough margin for me. So that was one of the reasons I never really went that route at that time, but I don't have enough experience directly or indirectly to really speak on it more than that. And I could have been totally off. It could have been I didn't know what I was doing. I could have been running it wrong. I don't think so, but that's kind of what I saw and why I stayed away from it.
Hey, it's Jonathan. I hope you're enjoying this episode with Chris Grenzig. And if you want to just meet other real estate investors like me, like Chris, wherever you are, you need to go to real estate investing meetups. If you live in New Jersey, I've got you covered. We do real estate investing meetups every single month on the first Wednesday of every month. Barring if it's a holiday, then we just move it 1 week ahead, and we're always there. And we've been doing these since 2020. During the pandemic, we were doing 7 a week online because we were all really bored. But now they're once a month. They change locations. You can find them if you go to our website, zenandtheartofrealestateinvesting.com, and click on the events button. You RSVP there, and I hope to see you there. Let's get back to Chris. Yeah, I mean, I think that's helpful because I think a lot of new investors are looking at flipping, thinking that's going to be their way out of wholesaling into like long-term investing. But like all those businesses are really hard. And if you start in multifamily, you just start with a little more scale. And yeah, maybe you don't want to be a manager, and I want to get into the property management aspect. But like to me, if I'm looking at all these things, flipping is just hard. I mean, if you're bad with design and you're not good with money and you don't know any contractors, you're losing money. You know, it's just that there's no way that you're making money. I've seen so many like just horrendous flips where you're like, wow, they really thought this was going to sell. It just looks insane.
Yeah. And the issue that I have with BRRRRing, which I think I can speak more to, is it's almost the same issue, except now to BRRRR properly successfully, it's the same margin problem. If you want to fully BRRRR, right? If you want 100%, you need to be at 80% of your ARV or whatever you want to do it at least. And that's, with the way yields are today for rent, with the way interest rates are today, if you were to get an 80%, if a bank was just going to give you an 80% loan for a property today, I would almost guarantee 99% of those will be negative cash flow.
Yeah.
Because if you do the math with where stuff is, you have to be at like, what is it? The like 2% rule now in order to have a property that cash flows, because if you really do it right, your cap rate has to be so much higher than the interest rate to have positive leverage to be able to put down a lower deposit loan. But you're not buying, definitely not multifamily and single family. You're not buying 8, 9, 10 caps.
That'd be nice.
It's just, not possible. So it's just a really, really difficult thing to make work, and is actually, almost tougher than flipping in a way, because you have to, if you can only get a 65% loan, that means you have to fully BRRRR out all your money. You have to be at 65% of cost, which just, I can't imagine it's going to be. And if you could do that, well, you should turn around and sell it and make a ton of money, in my opinion.
Yeah. And that's why, I mean, I've just seen people, they're like, oh, I read the BRRRR book. It's like, but that was written like 8 years ago. Things were different. The BRRRR process is smart, but you have to figure out and there's still markets. Like I think the Midwest, you can do a lot of these strategies because there's a little bit, but the scale is very small there. You could go from 200 to 220 or something if you do a lipstick flip. Like it's every market's different. And I think people, they consume things, they take a class, they watch something national, and then they're, in the middle of Kansas or something. And the way that it works in Kansas isn't how it works in Long Island. That's for sure. So have you found that the locality of the markets has really played a role, like you learning Jacksonville and now learning Orlando, especially on the management side versus what you want to buy there?
I think local market knowledge is severely underrated.
Yeah, I agree.
So when I was first looking to buy a property for myself in 2020, I actually started looking in Indianapolis. John and I had talked about investing in Indianapolis on multiple occasions while I was working at Toro. We looked at properties as early back in late 2016. And there's a funny story where we looked at a deal in Indianapolis. It was like 200 something units. It was like not managed properly, needed some money, but nothing crazy. I want to say it was like 80% occupancy. But like their expense ratio on that was like 60% or something. So like if you could clean up the expenses, get occupancy up, you would be at a normalized 50%, 45, 50% expense ratio. And it was a decent deal. And we ultimately didn't do it because we didn't know enough about Indianapolis at the time. It didn't have as much going for it at the time as some of the other places we were looking. We had presence in other markets. We were still finding deals in those markets we knew. So we weren't like jumping into it. In hindsight, we should have bought everything in Indianapolis and then we would have been doing really well. But cap rates at the time were 7.5%, 8%. Interest rates were 4.5%, 5%.
Yeah.
So you had crazy positive leverage and these deals, but that market was always a cash flow play. It was never a huge appreciation play. So there was a deal we looked at in 2016, and then it came back around for sale. I want to say in like 2019. The NOI had dropped, but the price per door from where they bought it from and what they were asking now had doubled. And we were cracking up because during that time, more and more people were looking for these value add opportunities. They were going outside there. You couldn't find anything in Raleigh, North Carolina, and Atlanta. You were buying 4.5 caps in Raleigh, and that didn't really work anymore. So people were looking for other stuff. So instead of buying a 8 cap in place 8 cap in Indianapolis in 2016, now people were buying a pro forma, 8% cap rate, but in reality, your cap rate at that time was like 3.5%. So it sounds like something that wouldn't make any sense at all. Somebody bought into it and bought it. We didn't. We were just like, that's crazy. We should have bought it years ago and we didn't. Basically, somebody bought it, messed it up, and still made a ton of money, which is like the dream, right?
Right, but they probably put that into something else, thought they were going to do the same thing and got creamed.
Probably, yes.
Yeah.
But it's just one of those things where you look at it and it's like, okay, looking at different markets is a potential to find something that maybe doesn't work in a market you're already in. However, going back to my original point of local market knowledge is underrated, I was sitting there for like 2 or 3 weeks. I was trying to find out like what neighborhoods are really good in Indianapolis, like all like the basic stuff you do up front. And I was really trying to dig in. And then I was sitting there one day, I was like, what am I doing? I have 4+ years of insight into deals in Jacksonville, where if somebody calls me up, I know very, very quickly if that's a good deal or not a good deal. And I started scratching my head. I was like, the amount of risk I'm adding to a deal in Indianapolis versus Jacksonville is astronomical because I don't have any resources there. I haven't seen the market play out over years. I saw deals here and there, and I could look back if I had an OM from years past, but I don't really know the story behind it or what happened. For 4 years in Jacksonville, I'd been going down roughly every other month. So I had multiple trips to the area.
Yeah.
And that stuff is huge. And because of that, because I made that shift, I was able to find a deal in my wheelhouse at a price that worked up the fairway for me because I had experience with almost a carbon copy deal around the corner, and it just worked out.
Yeah.
Yes, now I haven't bought a deal for so many years, but we did look at in late 2022, early 2023, we did start looking in other markets in like Georgia and South Carolina, North Carolina, trying to find stuff that worked. Ultimately, there were a lot of reasons why we just didn't go down that route.
Yeah. I mean, I think it makes a lot of sense. I think people got comfortable out of state investing in the pandemic because, none of us were really looking in person in the beginning, and they're, bidding off of pro forma and all the statements. But then you realize, like, take Philadelphia, for example, during the pandemic, my meetup group, they did about 40 different deals in Philadelphia. All of them did well. They're still doing well, but you can mess up in Philadelphia real quick. And we had experts there. You can go like literally 5 houses in one direction and go a complete different trajectory. And I think your point is really good for newer investors and seasoned who are trying to check out new markets. You might think you know it from talking to people on Google Maps, but you don't know it unless you're there. because you just don't know where the areas break, what's coming. You have no knowledge when that new Starbucks is hitting a new neighborhood, or when the crime has gone up in one part and it's going to depress rents. You're just not going to know those things. And so I think because you knew that Jacksonville was going to be a good market for you, but you still didn't live there yet, which I think helps people realize you can do it, but just focus on one market and get as many reps in that market as you can. If it turns out after a year that it's not going to work, at least you have all that knowledge on how to vet a market that you can take to a new market and hedge your bets, instead of just looking at every top 10 list that comes out and saying hey, this is my new market, Oklahoma City, which is a good market. I like it a lot, but I don't know anything about it. So I try to look again, like you were saying, I try to look, but I'm I don't know what's what. I just don't know.
Yeah. And, it's interesting that you bring that up, because we manage a portfolio of single family homes for an owner in Palm Bay, which is an hour and a half away from us on the coast. And we just had a move out. I went to go look at it. And this one house, in the year since we've leased it and I moved back, or unless my memory's way off, the street just kind of got worse. The houses on the street just weren't super great. And I drove the immediate little neighborhood on my way out, and a lot of the other streets were fine. And when I just drove down it, and my wife happened to come with me because she does help me with some stuff, but also a lot of times when we go to these areas, we end up going and doing something afterwards. So we turn a little work trip into a quasi little date night.
Yeah.
And we're just driving. We're this is, if I drove down this to go see it, I'd keep driving. I wouldn't stop. And so that's a conversation, we're going to be having with the owners is look, guys, we're going to list this for our normal rent, but there's a really good chance
you're going under.
We're going to have a bunch of tours scheduled and people are going to skip them, or we're not going to lease it. And we might actually have to drop it below what we think, because there's a lot of other houses on this block that just don't look good. And that's not something you would get if you just drove the neighborhood. Or, like I said, to me, again, I don't remember exactly, but I don't remember having this perception of this property a year ago. So it's okay, that's changed in a year.
Yeah.
And that's stuff outside of your control, and that could change at any time. But that's one of those things where, whenever we were buying properties out of state, we usually would have a property manager go see it first and just be hey, what do you think? And these were much larger properties, so it was a little bit different, right? Because then for them, winning the businesses, significant revenue for their company. So a little bit different of a thing, but we would also then take a trip and go see it. A lot of times before offering, sometimes prior to offering, but then during our inspection period. But somebody we know on our side has checked it out before we're offering, because those things you just don't know until you go see it. And then it's just crazy to see. So you can do it out of state. I think you got to have a lot of the resources there. You got to just be willing to be look, there's some stuff you're not going to know, or you're not going to be as up to date as somebody who's there all the time.
Yeah.
But if you can buy right, be conservative and find deals that work, you can kind of ride out some of those little things.
Yeah, it's just you made a great point about your personal boots on the ground. And I always say, just get someone who's not getting paid by you in some way on the deal, that you can trust, just a friend. So I would always tell people hey, if you're looking for markets, make a list of where all your friends and family live. Make another list of every place you've ever lived. So now you have a competitive advantage of you either know the area, or you know someone who's unbiased in the area, and then see if any of those line up with the top 10 list. And that's at least a good way to start. If you lived in Oklahoma City and your cousin lives there now, and it's in top 2, great, hedge your bets. At least you have someone there who can give you a 360 view of that cul-de-sac. And then, like you said, okay, wow, those 3 houses are burnt out. That doesn't seem like it's going to be a good value block. Whereas instead, if your house doesn't look so great, and then you spin it and the other 3 houses are all renovated, you're about to hit that value, and you have comps sitting right there. It's a big difference. And property management, some are good, some aren't, as you're in the business. But you could send someone down there and they could just give you the best case scenario. And what I really liked about what you said is you gave your client in Palm Bay the worst case scenario. Said look, we're going to do what you want. You want to put it out at this amount, but I'm just telling you, this is a downhill trajectory, and there's no way to know why. Maybe I don't know, but it's very smart to give them that transparent, because maybe they want to offload like that one, like the one guy who you got your deal from.
Yeah, you've always got to be careful with who's going out there to look at something. The example of like a friend or family member, if they don't have real estate experience, they might not know exactly what to look for.
Literally tell them.
But in some ways, that's also helpful too, right? If your friend goes down and says, this place looks like crap,
right, and
they're possibly in your renter pool, you're like, okay, it doesn't really matter what experience they have. If they wouldn't rent it, then okay, you want to know why and like what they saw. I do think if you are going to be out of state, finding somebody that you can rely on consistently, a lot of times that comes with, paying somebody to go out and do it and, have that expertise or be able to like take a high level look and just be like, hey, look, I'll give you, I don't know what the going rate would be, but $50 to go swing by this property, drive the neighborhood, take some photos and videos and send it to me. That's cheaper than flying down and doing it yourself. So sometimes you can
find so many people
front too.
Yeah, you can find so many people, even friends of friends, who will do that. Like, especially like teenagers, like 17 to 25. Like, they'll take $50 all day. That's like two.
Absolutely.
These days it's like one meal, but it could be 2-3 meals if you're hitting Chick-fil-A. Like, I mean, and they start to learn stuff. It's how you can kind of build these relationships, as you were saying, and as I said, like just without a bridge. They're unbiased. You're paying them, but they're not like on your salary or hoping to get 60 units from you. They're just like, going to look around. But I like what you said. If they're inexperienced, it can be a con, but it might just be a pro. They could think something is good, and then you could realize, it's bad. Like, hey, oh wow, this is awesome. It's right next to a school, and you're like, well, I wasn't really shooting for the traffic. So you're adjusting, your deal on what's that worth. But that unbiased view, I think it is really helpful.
Yeah, I like getting different opinions on things because you never know how somebody's going to see it. And I think there's a lot of value in experienced, unexperienced opinions on things because they might just see something differently or approach it in a way you wouldn't have thought about. I know since being with my wife, and she has some background, but not direct background, she looks at things very differently than I do.
Yeah.
And I find that oftentimes, at least a lot of times insightful and things I wouldn't think about, but at other times at least thought-provoking and making me think about it a different way. And a lot of times there's considerations that I'm thinking of that she's not, because I come from more of that like financial background and analytical background. And that's just who I am a little bit by nature as well. But there's a lot of times where, and she's definitely like creative and like design oriented, things like that. And a lot of those things are extremely helpful to me where, there's kind of, you can't always, what's the dollar value, appreciation value of a fresh coat of paint on the exterior. But, if you redo a bunch of stuff, somebody's probably going to, their first impression of a property is going to be way better. And it's going to set a different atmosphere for that person. Like you can't put a dollar value on that. So that input for me is valuable because you can't exactly measure it. So I do think having different people look at stuff is good. And yeah, you always do have to be careful with management because, at the end of the day, there's a lot that even if I look at a property and I'm being totally unbiased, I can think one thing and then it can be totally different, right? You may not know just because you look at a property and, you don't know that 5 ACs are about to blow. You can't predict that or budget for it. But, like you said, there's incentive for a property manager to be like, yeah, you should buy this one and hire me because now I get the management for that. I do think that is a very bad long-term outlook because if you say, oh, you should buy this and then you have to start dealing with all these problems, it's bad long-term for two reasons. One, it's going to strain your relationship with them, make you spend a lot more time on a property than you otherwise would have and your relationship. And there's a good chance ultimately you get fired one way or another, and it's going to tarnish your reputation. But, a lot of people don't think that way. Or they need the property to stay afloat or make payroll or something like that. So, there's definitely incentive for a management company to be like, oh no, you can you can do this. But a lot of times you can just get it wrong too. We bought a property in Jacksonville while I was at Toro, and the property manager there, who we worked with well for a long time, she grew up not too far from there. The property had wasn't in the best area, so it had some security that patrolled after hours and on weekends. Yeah. And she was of the opinion, and we agreed. So this isn't like I'm putting this on her. Ultimately, it was our decision at the end of the day, and we owned that. But she brought up like, hey, I think we would probably get rid of the security guards and just make the gate work again. And that'll, upfront cost to save a ton of money on your P&L. And that goes right to the bottom line. And so we agreed. And ultimately, we ended up having to reinstall the security back on the property because there was just a lot more issues that cropped up. So sometimes you just get it wrong and you just got to figure it out from there. So you do have to be careful as well who you're asking opinions of.
Yeah. Awesome. Yeah, I really like these last points. Before we hop off, I wanted to get your opinion on where you think property managers are making the biggest mistakes now. And then I'll have one more for you before we hop off.
That's a good question.
I mean, it could be market specific to what you know, but I feel like there's always like, hey, there's all these property management companies, they all suck. People say it's like, I don't think you've met the good ones. Then I'll explain why in my next question.
Yeah, I think this is going to be a little bit more industry specific that may not have actually hit a lot of people's like register yet. Because I read a lot of stuff, I listen to a lot of things to try to make our property management company better. And there's a big push right now for property managers to start taking on asset management services. So either as an additional fee or as part of their package. And I am very, very nervous about that. There's some benefits to it. I know a lot of it is targeted at like mom and pop landlords, right? The accidental landlord who has, bought a house, 3% rate, buying a new house, let's just rent it out. I think some of that is helpful. And there's some softwares out there that do a lot of that stuff that I think is helpful.
Yeah.
But there is a lot more that goes into being an asset manager than I think most property managers know and are, I don't want to say capable of, but it's just different.
I agree.
And there's a very big push for it right now. And I haven't looked into it like a ton. So I'm speaking a little bit from not direct experience or direct knowledge, but I'm very, very hesitant on property managers stepping into that role because it's very different. It's a different skill set. It's a different attitude. And a lot of the conversations are also starting to dip into the toes of like financial manager.
Yeah,
like,
right.
Well, why don't you sell this and roll it into like an ETF? And it's like, that's not your job to advise somebody on that. I don't think anybody's actually doing that.
Right.
And it's coming from a good place, right? It's coming from the desire of like, what can we do more to serve our clients, to serve our investors, to make things better for them, right? Does the accidental landlord know they can 1031 this old property into a new construction house, right? And the idea is twofold, right? How can we be better service to our clients? How can we also keep the business, right? And do things like that. So there is some self-serving interest in it as well. But I've heard more and more of this conversation popping up the last several months, and it worries me a little.
Yeah, I completely agree. I mean, I always feel like you just want to deal with experts. So I want someone to just be one thing and then, hey, have a good referral partner. Maybe you get a kickback referral agreement affiliate, but to send them over to someone who can help them manage the asset. If they say, I'm thinking of selling, but I don't really know what to do. And you don't have that expertise, like you said, you can get yourself in trouble. From the other side, my last question for you is, for somebody who is either an accidental landlord or has very minimal amounts of units, how do they get a good property manager? Because as property management companies grow, it's like they don't really want, just a one-off accidental landlord. It's not a good, scale. So how do you find the good property managers who are willing to take that kind of 1 to 2 to 3 to 4 unit before they build up?
So in my experience, there are a lot of management companies tailored towards serving that type of clientele. Like we are happy to and look to work with, single owner, type landlords.
Yeah.
They're the majority of rental properties that I don't know if it includes apartments or not, but are, self-managed. Like there's a lot of self-managed people out there, and there's a lot of reasons for that. But I think understanding, like you're saying, is just what that property management is tailored towards. And if they're a jack of all trades, that might not be who you want to work with anyway. So I'm always really, if I see a property management company that does long-term rentals, short-term rentals, retail, like unless they have like specific people or divisions set up to handle those things, or they own that stuff, and so they have like direct experience in that, I'm always very hesitant on that. Like we don't do any short-term rental stuff. We don't do retail, industrial, because I don't know anything about it.
Yeah.
We don't even do for our property management. We stay within, the single family, single unit stuff. And we go up to about 50, 60, 70, 80 units. Basically, once you get a multifamily property that has an office on site and on-site staff, that's where we stop.
Yeah, I think that's smart. Yeah.
I could do that, but we're not set up for that. We don't specialize in that. Maybe I have ideas. Maybe one day we offer that, or we have a sister company that focuses on those things, but not currently. So really understanding what that management company specializes in, I think is great. And then I think it's looking at, Google reviews is always a pretty decent tell, right? Having a lot of good and mixed reviews is telling, seeing what, the different types of reviews are and what the issues are.
And the responses, honestly. Yeah, when the responses are all the same, I feel like, well, that's kind of silly. Thank you for calling. Please call the office. It's like, well, you're not really responding to the review. No one's there.
Yeah, that's definitely a good thing as well. I think really just trying to find one that aligns with what you want to do. I think one of the toughest parts with owners hiring a management company, especially if they've ever self-managed, is an owner has a particular idea of how it should go.
Yeah.
And a lot of times that doesn't necessarily line up with a certain management company, or really any management company, because a property management company has to create systems and processes to best serve as many clients as they can.
Yeah.
And sometimes, a lot of times, a self-managing landlord can do things that a management company can't do. For example, I spoke to a woman who self-managed for a while. She was asking about how to handle maintenance things, and a typical thing you see in a management agreement is a not to exceed clause. So, for example, if a repair comes in, it's less than $500, we just go ahead and do it. We don't need your approval. We take care of it. It's kind of run of the mill, and that's fairly standard. The dollar amount might change from company to company, but that's roughly a common thing you'll see. And we also will not get multiple quotes for those things, because we have a general idea of what those things should cost.
Right.
A couple of dollars here and there isn't
and providers
huge.
That you trust. So
exactly. And a lot of time, to get 2 or 3 quotes for, if you send somebody out to quote you 20 times, eventually they're going to stop if they don't win the business as well.
Exactly.
And they're not going to give you, a lot of times they don't want to give you a quote for a $150 job. They're like, am I getting this or am I not? Because I'll go somewhere else that's just going to send me and go. And they said, typically I send 3 guys out right away. They give me 3 quotes and I choose one. I say, look, that's fantastic. I don't even know how you managed to organize that. I said, we don't do that. And
I don't know who's going out to do that.
I don't either. And she said, oh, well, I really need that to happen. I said, well, best of luck to you. I hope you find somebody that can do that for you.
Yeah.
And some of this is just like, or a lot of times it'll be like, well, I have someone who, like on a payment plan or something, or, I let them pay a certain way. And it's like, sometimes that's okay. Sometimes it's not. You have to be very careful.
Yeah.
And it's just, sometimes it's an education process. So I think just understanding how someone works, feeling comfortable that they're going to take care of you. I think also another thing too is understanding how the property management company is organized. There's a lot of different ways to structure a property management company. So a lot of times, kind of the couple main ones are, there's like a portfolio style where it's like one person oversees like 100 units, 300 units, whatever. and that's your main point of contact. They just do everything.
Right.
Then another one is like departmental, and it's like there's a leasing office, there's a maintenance office, there's this office, and you might have to talk to a few different people, but everyone's specialized. Everyone's, really knows what they're doing. And then there's some hybrid structures in between those two that you can kind of find. So it's really just understanding too, like, is it really important for you and your tenant to have one point of contact, or is it not that important? How do you want to interact with that company? So I think that's another thing I would encourage people to find out as well.
Yeah. Awesome, man. Well, I really appreciate it. Is the best place for people to find what you do at orlandoproperty.management?
Yeah, that's our property management website. If questions on management or anything like that, you can find us there. Eventually we'll be, we're still looking for acquisitions and things like that. Kind of our acquisition side is jagcapitalpartners.com. And if anybody wants to follow me or get in touch with me, I'm active on Instagram and LinkedIn. Just search Chris Grenzig. You can find me, or anybody can just email me, chris@jagpmg.com.
Awesome, man. Well, I appreciate it. It's good to see you again, and glad to have you on the show.
Yeah, I appreciate you having me.
All right. That was Chris Grenzig of Jag Property Management and Jag Capital Partners. I'm Jonathan Greene. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 296 of Zen and the Art of Real Estate Investing. And it's my friend, Mackenzie Great. You might know her by Mac of All Trades on Instagram. Her website is Moat Interior Designs, and the Moat is for Mac of All Trades, so that's MOAT. We're going to talk about short-term rentals, long-term rentals, how she got into rentals, how she got out of her regular education job, and all the things that she's learned along the way. We also talk interior design and what works in upstate New York, where she works and where I work also part of the time. We'll see you next episode with Mac of All Trades.